Welcome to this video. Today we need to talk about Oracle. Oracle is a company that's famous for its database software, but now they're changing more to AI. They're building infrastructure for AI workloads, and they're building massive data centers right now, and they're taking on a lot of that. So the question is this going to pay out? And is today a massive buying opportunity for the long-term investor? Well, let's find out in this video. We're now looking here on TradingView on the charts, and Oracle's now trading at $146. We can see that it's been in a long downtrend, and from all-time high, it's down over 50%. And it looks pretty oversold. It's also far from the 200 simple moving average. And a lot of time when a great company goes far below the 200 simple moving over average, it tends to snap back to the average. And that's why I think that Oracle could be a very interesting buying opportunity. But let's go over the fundamentals as well, and then we come back later to the charts to find out whether Oracle is really a great buying opportunity and whether there is a margin of safety for long-term investors. From origin, Oracle has always been a database software company, but now they're moving to cloud. So they want to do everything on the cloud, and they're going to use AI to make it more efficient. And here we can read Oracle offers the highest performance cloud service at the lowest cost. That's why so many of the world's biggest technology companies use OCI, Oracle Cloud Infrastructure. And they're building data centers rapidly as well. So they're taking on a lot of debt to make this possible. And that's what makes this company a little bit more risky, because they're using so much debt to build data center after data center. And that they cost a lot of money, but they're betting on the future as an AI infrastructure company. And here we can see Oracle AI database in 200 plus data centers and multi-cloud AI database. So whether you're using Amazon, Google, Microsoft, you can still use Oracle services in there as well. So it's basically global, which is great. So they're betting on the future, but they take a lot of money to do that. So they're taking on a lot of debt, and that's the risky part. So let's go first to GuruFocus to find out whether this is a great financial company. Well, GuruFocus itself gave a score of 92 out of 100, which is pretty good. So they say that is a pretty solid company. And if we look here at the financial strength, we can see it's a 4 out of 10. And this is because of the debt. So it's not the greatest financial strength because they're taking on a lot of debt to build these data centers at a massive, rapid rate. But they are very profitable. They're making a lot of money, a lot of revenue, and they make positive net income every quarter, which is great. So here we can see the financials. You can see that the revenue has gone up in the last few years, and we can see that the net income is not growing that much, but at least it's positive. But here's the problem. We can see that the debt is increasing every single year. And why is that? Well, because they're taking a lot of debt to build these data centers. If we zoom in here on the chart, we can see that the debt levels are really going out of hand, and the cash is pretty low compared to the debt. This is a little bit risky, but overall I would say that Oracle is a strong fundamental company. So now we're going to find out whether Oracle also has a wide economic moat. So let's continue. So what exactly is an economic moat? Well, the term economic moat refers to a long-term competitive advantage that a company holds that protects its position in a marketplace. So during the medieval times, they built castles, and a castle with a strong moat, which is the water here, protects itself from invaders. So a strong moat protects the castle, and it's the same with a business. If the business has a wide economic moat, it's protected against the competitors. And that's what we want when we invest in a company, and it's really important for long-term investors. So this theory is popularized by Warren Buffett himself, and here we can read, investors such as Warren Buffett state that buying businesses is like buying castles. Buffett emphasizes the importance of buying businesses with deep moats, as they are protected from competitors and can therefore maintain strong profits. To find out an economic moat of a company, I built an economic moat analyzer. So here it is, and we can type in here the ticker of Oracle, which is ORCL, and let's analyze it. So it takes a little bit of time, and we can find out that it is a wide moat. So it's a 7.8 out of 10. That's the overall score. And it's based on the brand power, switching cost, network effect, cost advantages, and tangible assets. And I would say that the network effect is the lowest at a 6, but they still have a network effect, but it's not like the strongest. And their strength is high switching cost and intangible assets. And here we can see the verdict. Oracle possesses a formidable wide moat, primarily driven by exceptionally high switching costs for its core database. So it's a 9 here. And enterprise applications. Its strong brand and extensive intangible assets further solidify its competitive position, making it a challenging incumbent to dislodge. So what does that mean? Well, it means that the company is already strong and established, and now it's becoming very hard to replace or compete with. And the incumbent refers to Oracle as a company that's already empowered and now the current leader. In short, Oracle has a wide economic moat with an average score of 7.8 out of 10, which is great. So let's continue. The next question that we're going to answer is whether Oracle is cheap or expensive. Do we have a margin of safety as an investor? Well, the first metric we're going to look at is the price to earnings ratio. And this is the most basic way to value a company. And the price to earnings ratio of Oracle is now around 26.41 and the stock price is around 147. And we can see in the last 5 years, we can see that the stock is generally higher than before. And the PE ratio is also slightly higher, but now at 26, I would say it's pretty average or even slightly below average if we look at the last 5 years. To find out the true value per share of a company, we're going to use Warren Buffett's owner earnings combined with a discounted cash flow method. So what are the owner earnings? Well, the owner earnings is a valuation method detailed by Warren Buffett in Berkshire Hathaway's annual report in 1986. He stated that the value of a company is simply the total of the net cash flows, the owner earnings, expected to occur over the life of the business minus any reinvestments of earnings. So here's like the formula you can read. And the owner earnings is basically the money that's left for the stockholders. And we discount all the future owner earnings to present value. And we discount it with a discount rate to find out the true value of the company today. To find the true value per share of Oracle, we're going to use this intrinsic value calculator. And in this intrinsic value calculator, we can fill in everything from trading view on the balance sheets and on the income statements in billions of dollars, because everything is nominated in billions to make it easy. And for the earnings growth rate, for the expected earnings growth rate for the next 5 years, we're going to use 15%. Because here, like on Finviz, they expect it to grow even higher at 21%. So I would say that 15% is pretty conservative. We're going to use a discount rate of 8% because money today is more valuable than money in the future. So let's find the true value per share. Let's calculate it. And we come to a conclusion that it's fairly valued, but maybe slightly undervalued with a potential upside of 9%. So the intrinsic value is close to the market cap. And the true value per share is roughly around $159. So if you buy right now, you would have a margin of safety. And of course, they're taking a lot of debt. So if their whole AI infrastructure play is going to work out, then this stock could easily double in market cap. So buying right now would give you a margin of safety based on this intrinsic value calculator and based on the PE ratio. If we look here on Alpha Spread, they also do a intrinsic value based on a discounted cash flow model as well. And they come to a conclusion that it's around $194 on a base case scenario, so it's also undervalued. So I believe that if you buy Oracle right now, you would have a margin of safety, which is always good to know. So the true value per share is roughly around $159. And if we go back to the charts, we can see here that on TradingView again, it's now trading at $146. So let's put the intrinsic value around like 159. Let's put it on a 160. So it's roughly around the intrinsic value. So we're buying with a margin of safety if we're buying right now. If we look at the trend, we can still see it's still in a downtrend, but it's very far from the 200 simple moving average, which could be a signal that we will snap back to the moving average. So I think that at least starting with a first position here for Oracle is pretty good, because if we look here on weekly candles, we can see it's finding support here at the 200 simple moving average, which is a great support line. And I think the most likely way is that we will go up from here. I think that's the most likely outcome. Of course, always do your own research, always do your own due diligence. This is just for educational purpose only, but if you like this content, feel free to like and subscribe. And if you want to learn more, feel free to check the link in the description down below. With that being said, have a great day, and I'll see you in the next video. If you want to learn how to master stock analysis like a pro and find winning stocks and beat the market so you can build a portfolio that consistently wins, then feel free to check the link in the description down below.